Hey everyone, this week I'm going to focus on the interest rate outlook. So, President Trump's pick to head the Federal Reserve when Chairman Powell's term ends on May 15th is Kevin Warsh. And he went before the Senate Banking Committee for a confirmation hearing last week. He has strong credentials and served as a Federal Reserve governor in the past. He's generally considered to be highly qualified for the role. But the question on investors' mind is how he'll influence Federal Reserve policy and interest rates. Now remember, the Federal Reserve has a dual mandate. They have to walk the line between maximizing employment and keeping inflation down. And currently, the employment market is soft but stable. Job creation has been relatively weak, averaging just 22,000 jobs per month over the past year. But the unemployment rate has held steady in the low to mid 4% range. Historically speaking, an unemployment rate in the 4.5% range is considered healthy and aligned with full employment. On the other hand, inflation risks have been rising. That has largely been driven by rising energy costs as the price of gas has increased by more than $1 since the start of the Middle East conflict. As a result, the Consumer Price Index rose 85 basis points last month to 3.3%. We're still waiting for the release of the Fed's preferred measurement, the Personal Consumption Expenditure inflation reading, but the current forecast has the headline PCE inflation rate rising by about 60 basis points in March to the 3.4% range. And remember, the Fed wants PCE inflation to be about 2%. So Wall Street doesn't expect the Federal Reserve to lower rates anytime soon. Before the conflict in the Middle East started, Wall Street predicted a 17% chance of one rate cut by the end of the year, a 31% likelihood of two cuts by the end of the year, and a 48% probability of 3 or more cuts by year end. But now, Wall Street investors are assigning about a 70% likelihood that rates will remain unchanged by year end, with just a 25% probability of one rate cut. So what's that mean for commercial real estate investors? At the start of the conflict in the Middle East, both the 10-year and the 5-year Treasury shot up by about 50 basis points. And because of the interest rate risk, commercial real estate lenders started to widen their spreads, pushing up the cost of debt capital. But in late March, the Treasury rates peaked and started to ease back down. Now, Treasury rates appear to be stabilizing. In addition, the blue chip economist consensus year-end forecast has the 10-year pegged at 4.2%. So essentially, at least according to the blue chip consensus forecast, Treasury rates at the end of the year will be about where they are now, which implies rates should be relatively stable and range-bound this year, barring a major disruption. And in my opinion, that's good news for commercial real estate investors because rate stability would support lender confidence, which in turn could lead to tightening lender spreads and a modestly lower cost of debt capital. So commercial real estate lending rates went up in March, but they have since come back down. Bank rates on commercial properties are close to where they were in the fourth quarter last year in the low to mid 6% range. CMBS is still a bit higher than it was, running in the 7% range. And multifamily rates are also still a bit higher, running in the low to mid 5% range for agency debt and the low 6% range for bank lending. But it looks like we're past the brief rate surge and moving back towards stabilization. No guarantees here, but that's the trend I'm seeing at this point. So there's still a lot of uncertainty and no one has a clear picture of what geopolitical curveball may show up next week or next month, but the current commercial real estate outlook remains sound. As Mark Zandi, the chief economist of Moody's, said on the Marcus and Millichap webcast last week,
CRE is sitting in a pretty good pole position here, right? Because it's gone through its correction, prices have come in. I think CRE is set up in a pretty good spot for good returns going forward, particularly if you think we're going to have a higher inflationary environment, no better asset class to kind of invest in. So You didn't ask me to say that, Hassan, but that's my view.
So there you go. Commercial real estate looks like it's in a good position and the lending climate looks like it's stabilizing again. A positive outlook for investors who keep their eyes on the horizon.